Hi everyone and welcome to my morning report on Thursday the 3rd of December with me, Rich Perry, market analyst at Handtech Markets. It's ECB day and, well, we're expecting the ECB to significantly change its quantitative easing program, to extend the program, easing measures all over the place, cut the deposit rate, extend quantitative easing asset purchases by, well, could be anything between sort of 5 to maybe even 15, 20 billion euros a month, and also increase the length of the program as well by maybe 3, 6, or even 12 months. So lots going on, lots of uncertainty as to exactly what the market's expecting, but a lot has been priced in already. The German 2-year Schatz down at well below negative 0.4%. So quite a lot has already been baked into this price. So it sort of begs the question whether the euro has gone too far or not. But the other angle on that, on euro dollar certainly, is this strong dollar. We had Janet Yellen yesterday speaking rather hawkishly at a conference, and giving the impression that certainly the December rate hike was on the table. She continues to remain data dependent, but still it certainly seems as though that market is sort of pricing this move in. Certainly the US 10-year yield started to jump again, and also the 2-year as well pulled higher. So market's still travelling on this dollar strength argument, and the trade weighted dollar is now breached intraday yesterday, breached that key March high, and that well goes back all the way, all the way to 2003, the last time it was up at these sort of levels. So very strong move on that US trade weighted dollar, and a breakout above 140 would 100 spot 40 would again be that move to multi-year highs on that dollar. So, basically, with this continues to see this dollar strength today. The euro is about 35 pips lower. Sterling continues to fall away. Sterling was sharply lower yesterday. Dollar yen higher. Interesting that we're still seeing the outperformance of the Kiwi and Aussie currencies. That's despite the fact that we've got declines on these commodity prices, which continues to see, and those Kiwi and Aussie dollars actually continue to outperform. So that is possibly a trade there. But certainly at the moment, we've got the commodity prices under pressure. Oil price sharply lower yesterday. And that comes ahead of the OPEC meeting, which is tomorrow, but still nothing really expected from any production cuts there from OPEC. So what have we got to look out for today? Well, we've got a lot of data again. We've got the ECB press conference, and well, monetary policy is announced at 12:45 UK time, and then you've got the press conference at 1:30. So a lot of volatility around both those times. But before then, you've got the service sector PMIs out throughout the day. You got the UK data at 9:30, 55.0, so slightly up from 54.9. That could have an impact on sterling. The ISM non-manufacturing data is expected to just dip slightly back to 58, but still quite strong there on the ISM non-manufacturing data. And also we've got at 1:30 we've got the weekly jobless claims, but I'm sure the market will be focusing far more on the ECB press conference. Jobless claims expected to be at 268 this month. And also we have factory orders month on month, which are expected to increase by 1.4% at 3 o'clock. So lots actually going on today, aside from this ECB meeting, but certainly that is the big focus. So my charts of the day. I'm actually looking at the FTSE today because FTSE's had this strong run higher in the last sort of 2 days, but I'm sort of saying that it's now coming up into this big band of resistance, 6487, which was the reaction high in October. That was in line with an old support actually. And around the 6,500 mark, there's a big sort of level of overhead supply back from sort of like the middle of the year, the midsummer points, providing that overhead supply so that FTSE may well start to struggle again. You've also got the RSI back up around this 60 point, which is around where it started to fall over in the summer, and find it difficult to really push higher, where the profit taking comes in. time and time again, the profit takers came in around that 64.50 mark, and that's just not far off where we find FTSE today. So we've had this run higher in FTSE, just really quite painstaking actually. If you compare it to the run higher in the DAX, for example, very, very painstaking gains on the FTSE, but still we've had this sort of drift higher, but could now come up into this big band of resistance. And the momentum indicators, as I said, sort of in line with as they have been performing in recent months, and now looking pretty stretched, as in every time the FTSE gets towards this sort of 60 mark, it sort of falls over. So that's what we're seeing again. Will this FTSE 100 start to roll over again around 60? In terms of the intraday chart, well, you've got a pretty recent, decent run higher, but again, look at these momentum indicators just falling away. You've got the negative or bearish divergence on the RSI and the stochastics falling away. MACD lines are certainly not suggesting that we're going to get an imminent breakout to the upside, I don't think. So it could well be that once again we're going to be struggling to find too many buyers up at these sort of 64.50, 6,500 area, and could well see that a bit of profit taking sets in on the FTSE. In terms of your initial supports, well, you've got the breakout level at 63.95, and then back towards sort of the old supports from late November into December, just above 63.20. 63.25 up towards, so you've got a fair amount of actually support between that in that sort of low 6300s area, but certainly I think that there could be a bit of a struggle with the momentum up at these sort of levels on the FTSE, and no real suggestion that we're going to see a breakout. It doesn't look like an index that's ready to break to the upside. So I wish you good luck in your trading on FTSE today. Obviously there's a lot going on with the ECB, but in line with that, I wish you good luck, and I will speak to you later. Thank you.